Good morning, everyone. I'm Brock Johnston, Public Relations Manager here at the Iowa Soybean Association. Welcome to today's Economics of Soy webinar, brought to you by your Soy Checkoff investment. We appreciate your membership with ISA, and to learn more about any of our other involvement opportunities, you can go ahead and visit that programs tab that's on our website at iasoybeans.com. The Iowa Soybean Association is driven to deliver the insights, tools, and activities and info needed to improve the competitiveness and profitability of Iowa's 40,000 soybean farmers. Today's interactive webinar is an example of this commitment. I'm confident you'll benefit from this timely discussion, and we'll go ahead and break down those key takeaways from the latest USDA and grain stocks reports, and we'll just provide some insights from our guests here on renewables and soybean oil demand. So our guest today, Mac Marshall, is the Senior Vice President of Market Intelligence for the United Soybean Board and the U.S. Soybean Export Council. And we also have Scott Gerlt with the as an economist for the American Soybean Association. Also joining us today, we have Grant Kimberley, Senior Director of Market Development for the Iowa Soybean Association. He's on deck here to help answer any of those questions that our attendees might have today, as well as ISA President Robb Ewoldt also on the call here to give some brief remarks. Our time together is going to be divided into two parts. So we'll begin with just some opening remarks from our guests, Mac and Scott, and then we'll just follow that with the Q&A portion from our audience, meant to be very interactive, just answering your questions here today with the hour that we have with you all. So if you have any questions during or after our guests' opening remarks, you can go ahead and share those using that Q&A feature that's at the bottom of your screen. We'll just be collecting those throughout the conversation, and we'll go ahead and share those with our guest presenters during the Q&A portion. So with that, let's go ahead and get started with a welcome from Iowa Soybean Association President Robb Ewoldt.
Hey, great, Brock. Thank you very much. Welcome back. Looking forward to round two here. And, I gave my best story at the first one, and I know we got some new people on here, and I always, and I'll give it again for those that never heard it, about marketing and having interns come out to the farm. And first thing I have them do in the early spring is to rebuild a planter so they understand how important that planter is. And then the second thing that we did, which is the second most important thing on my farm, is I take them to marketing meetings so they meet the grain buyer and understand that this, you have to grow it, and that's where it starts with the planter. But when you have to sell it at a profit and be as profitable as you can. And it takes a lot of information to make it all work. And, that's why I think we have two greats here today to help us out. Last time I said it was markets with Mac. And so then I had to come up so Scott didn't feel left out. So I came up with signals with Scott. Great. So that was the best I could do for you guys. So hopefully you're good with that. So we'll get right on and introduce Mac Marshall, Vice President of Market Intelligence for the United Soybean Board. He is on and the U.S. Soybean Export Council, USEC, and Scott Gerlt, the economist with the American Soybean Association. So Mac works with USB and USEC leadership to evaluate and establish long-term initiatives to support domestic and international market opportunities for U.S. soy. He also serves as an industry source of market information and analysis. Prior to joining USB and USEC, Mac served as global market analysis and trade lead at Bayer Crop Science, where he worked on international market access issues as part of a global ag policy team. Scott provides policy analysis and monitors markets and guide organization decisions as an economist for the American Soybean Association. Before joining ASA in 2020, Scott was a program leader for U.S. crop policy and analysis at the Food and Agricultural Policy Research Institute at the University of Missouri. We won't hold that against you, Scott, because
thank you.
Here. So thanks for joining you both, and to all the attendees. There's a question and answer feature up on your tab, so do that, and that'll help answer it. And to all of our members that are joining us, you guys have paid for this. This is where our checkoff dollars go. So we're trying to bring you something that you actually get to put in your hand and use. So have at it, Mac.
All right. Well, thank you very much for the introduction, Rob. And I do love signals with Scott, because one of the things that we like to talk about in the data world is really separating signals from noise. And that's why I really enjoy my partnership with Scott, is because I think we collectively help each other do that. Although I think I'm more on the noise side than anything. But with that, just a couple brief comments in light of last week's WASDE. And where we are in terms of markets right now as we look on January 20th and we look ahead towards planting season. So the most important updates that came out of the flurry of reports last week, of course, the WASDE, we also had the grain stocks report, and I think less noticed as well is the quarterly updates to the USDA's global balance sheets on the livestock side. So a couple things to pull out there. So first, starting with I think what's most timely and seasonal are the updates to South American production. Everybody's been, well, it's really been I think talked about not just this year but last year as well, the impact of La Nina, and of course we're seeing a second straight year of La Nina impacting South America. Last year, the initial expectations, I think, as Brazil got off to a slow planting start, were for there to be substantial cuts in production. That didn't come to fruition last year, but this year we're starting to see that unfold. USDA issued 5 million metric ton cut to production in Brazil from 144 million metric tons to 139, and issued a 3 million metric ton cut to Argentina, and cut Paraguay's production by 1.5 million tons. So basically knocking off about 9.5 million tons off of the global balance sheet on the production side. This translated into a substantial reduction in projected ending stocks, which are, of course, a good determinant of price overall, at least on a global level. And I think that cut was by about 7 million tons. Now, one thing that I just want to kind of urge caution about with all of this, particularly as we look at South American production, for better or for worse, I think, we tend to look back, 1 or 2 seasons in terms of, what's most recent and familiar. And the fact that we didn't have, that major cut to the Brazilian crop come to fruition last year gives me a little bit of pause this year for a couple reasons. One, when you have the, first off, USDA doesn't typically make cuts to their estimates of Brazilian production in January. So, they're taking into account the significant dryness across much of the southern production regions of Brazil, which is, of course, critical. But, for much of the last decade, if you look at the January estimates, and again, those January estimates usually don't incorporate cuts, and reconcile it against the final crop size, I want to say 7 out of 10 years or 8 out of 10, you've had that final crop size estimate come in larger than what was expected in January. Moreover, if you look at the 5 La Nina years over the last 10, 11 years, in 4 of those, the January estimate was understating what the final crop size was. So, I think the general consensus is that the dryness that has been felt, particularly in Brazil, is, not, it's already baked in. The crop is not necessarily going to rebound by any stretch of the imagination. Of course, it's already being harvested right now. But I just want to urge that caution right there, that there's always the potential, particularly as the market trades on weather for the next couple months, before we get our crop in the ground. There's always the potential for a change in the estimates there, which could be bearish for price. And the way that it would potentially be bearish for price is, of course, adding back to global inventories, and I think increasing the exportability of particularly Brazilian soy. A couple other dynamics that are unfolding here right now too. We've certainly seen a rally in meal prices over the last month and a half, and I think a lot of that is attributable to what's been going on in Argentina. Certainly, the dryness of the crop there is leading to decreased availability for their whole soybeans to be crushed and then exported. Recall, Argentina is the world's largest exporter of soy oil and soy meal due to their large crushing structure. And the tax incentives, which promote export of value-added products over the actual grain. So and I think exacerbating that is the drought in Paraguay too, where that drought in Paraguay, Paraguay primarily exports its beans to Argentina, which are of course then crushed. So with that drawdown there, I think it's part of the reason you've seen that rally in meal prices over, basically the last month. Two other things I want to call out, at least the quarterly, grain stocks that came in, I think, pretty close to expectations overall. So I won't belabor the point there. We didn't see any updates to the September inventories. Well, I mean, I think they took up inventories by, 1 million bushels, which whatever is a rounding error. And the other point I wanted to draw out is on China. Now, I think there's a little bit of a mixed bag there because, coming out of the Chinese government early last week, you had cuts to, expected corn imports, which are obviously a critical part of feed rations there. But then you also have reported both by the Chinese government and by USDA substantial upward revisions in the size of the pig herd in China. So showing year-on-year growth relative to last year, a rebound, to pre-ASF levels, which is certainly encouraging, I think, for anybody in the feed, grain, and oilseed space. So that's definitely encouraging. But and we've seen as well. We had some good export inspections this week in terms of a rebound in exports to China, at least on a weekly basis, after a couple tepid weeks of trade sales figures. And the other point I want to draw out too is we're also starting to see some forward purchasing activity by China for U.S. beans for the 22-23 marketing year. I've gotten a couple questions about why that is, and I really think we have to look at kind of the seasonality of everything and where the price breaks are. As we look at the price break between new crop and old crop beans, once you start to get to the September contract and beyond, there's about a 70-cent drop. China, of course, is always a price sensitive buyer. So forward contracting those beans for the fall when they're at a point right now where strategic reserves have gotten filled up pretty significantly, and that's primarily the supply from which they'll be drawing domestically over the coming months. It's not a position right now where there's a significant need for beans, but that will certainly change, I think, later in the year, and that's being reflected in some of those forward purchases. So obviously my comments here, I think we're focused on, the international dynamics. So I want to give some color there. I'll go ahead and pause because I know, we definitely want to hear Scott's perspectives and get to the Q&A. So thank you, and see you during the Q&A.
Sharing some of those points here. We will just remind the audience here that they can submit those questions using the Q&A feature throughout, and then we will get to that portion following some remarks here from Scott. So with that, I'll just pass it over to Scott to share some opening statements.
Thank you, Brock, and appreciate Iowa Soy having Mac and I here. And it's always a pleasure to be talking with Mac and also Grant as well. Great staff there at Iowa Soy. I definitely enjoy getting to work with Mac. He's given me kind comments, but he definitely makes my work better, and I'm always amazed at his insight on these things. So I think Mac really hit the big story coming out of the WASDE, which was South American weather. So I'm not going to belabor that point, but I do want to mention a few other, I think, important things. One is China, as Mac mentioned. We have seen a rebuilding of the hog herd there. When we think back over the past few years, there was a trade war, yes, but China also still needed less feed because of ASF. Their hog herd numbers were low, but those hog herds have largely rebuilt, and we're actually seeing very, very low profit margins for hogs in China right now, actually in the negative territory has been reporting. We saw crush margins at all-time low in China this past summer. So it indicates a lot of hogs, but it does create some uncertainty. Those sort of margins can't continue. So are they going to have to draw down some level of their hog herds, even if the hog herd remains healthy, just to have some rebalancing? The other thing I'll mention with China is the phase one trade deal. The targeted buying expired at the end of last year. Not sure that that's a big deal at this point. China did not meet their ag targets. There was a provision in there saying that it was subject to prevailing market conditions. And so China's been saying, hey, we had a pandemic. There were some extenuating circumstances. Now, the agreement does say that the trajectory is supposed to continue over the next several years. So if the agreement means anything, and if China abides by it, they are supposed to continue the buying. It's not necessarily that targets go away, the buying stops. However, we all know that political realities are much different than what's written in the phase 1 trade deal. So I think that creates an extra layer of uncertainty there. And I do think China is largely going to buy what they need to buy, as Mac was talking about. So I think when they need beans from the U.S., they will buy beans from the U.S. kind of regardless of the situation. And so I'm going to jump over a little bit to the U.S. now. There were some revisions in production for the U.S. soybean harvest. We saw higher yield and lower acres to actually give us a record soybean crop for this year. So we've also been seeing quite strong crush margins, as I'm sure you all heard about. Soybean oil went from a 35% of the value of the crush to over 50%, depending where you're calculating. But that's fallen back down. As Mac was mentioning, soybean meal prices have been increasing, oil's been dropping some. So the Illinois USDA crushing margin that I watch has the oil share at 43% right now. But with the strong crush margins, we've seen a whole slew of announcements for expanded crush or new crush facilities. Right now, I'm tracking around 15% increase in domestic crush capacity, but that increase is over several years. Of those plants I'm tracking that I have dates for, the first one would come online late this year, so not right away. A lot of that increase in the oil price that we're mentioning, and I already see questions about, is part of that is renewable diesel. There's quite a bit of excitement there. There's really 3 policies supporting that. You have your traditional RFS that I'm sure everyone knows about here. It's been around for years, and your biodiesel tax credit. The other important part of that is California's low carbon fuel standard. Although that's probably the lowest dollar-wise per gallon contribution, that is the market that's really taken that renewable diesel and is really helping expand it. There's been quite a bit of concern from food processors over this, the whole food versus fuel debate, but really we haven't seen soybean oil used for biofuels this past year go up. It's largely remained flat. What we have seen is some shifting between biodiesel and renewable diesel. So we've seen some shift in what fuel is consuming the soybean oil. Now, we do expect going forward fully that renewable diesel will continue to expand and there will be an overall growth in renewable diesel, but we haven't seen that yet. And the last point I'll make with this is vegetable oil prices in general have been under a lot of pressure. We've seen shortfalls in palm production in Malaysia. We've seen canola harvests really be hit hard because of drought in the northern plains. So there's a lot going on in the vegetable oil markets, and soybean oil prices have been falling while some of these other vegetable oil prices have been going up. And just the last thing I'll mention domestically is I'm sure everyone here is very aware of our input costs, fertilizer prices, which have thankfully been starting to come down a little bit. But that's created a lot of concern and a lot of questions about what we could expect for acreage this year. All else equal, that's going to push more acres to beans from corn. But if you also look at the soybean to corn harvest price ratio for this upcoming year, that by itself is favoring corn. So you can pay for some of the extra increased fertilizer costs just off of that price differential. So I think it's a little bit of a debate right now about how much we'll see acres swing between corn and beans. And so I'll cut my comments there so we can get to the questions you all would have. But once again, thanks, and I look forward to the questions.
Thank you, Scott, for those opening remarks here. With that, we will go ahead and just move into our Q&A portion of the webinar. So with that, we'll go ahead and open up the question here, and then wherever our guests want to provide answers or chime in, feel free to split those accordingly. So it looks like we have just a question that was submitted prior to the webinar here today that'll kick us off today. So the question that we have is, will we have enough acres to sustain the need for soy from a capacity standpoint, or will we reach a situation where there won't be enough soy? If so, will corn and canola oils take the pressure off soy and fill in those gaps?
Yeah, I'll provide a couple comments on that one. I think to start. So first off, I think I think there's a couple things to unpack here, right? I think we have to look at what the demand is on the oil side and we have to look at what the demand is on the meal side. As Scott mentioned, the oil share as it contributes to crush, it's come down in recent weeks as we've seen that surge in meal prices. But fundamentally, we've seen a structural shift where oil has taken on greater importance as a value driver over the last year, and that's really what's been incentivizing additional crush. So, I think one of the questions that pops up a lot as it pertains to how we're meeting this incremental demand, particularly in the renewable diesel and I think collective biofuel space, is I really look at there being, kind of three, area or three stages along the value chain that need some degree of bottlenecking. And the first one, of course, is at the farm level. In terms of just total production. And that's the one with which I really feel the least concern. I think, obviously you all grew a phenomenal crop this last year, even dealing with a lot of the drought and heat pressure that was felt through much of northern Iowa. But in terms of, total production for what on balance is needed, I think we're in a good place there for soy. It's really, the bottleneck's really further downstream. And that's where, we need increased crush capacity to create more oil for the energy space, but we also need more refining, bleaching, deodorizing capacity as well. And that problem, so that crush bottleneck, that pinch point is I think getting solved. As Scott mentioned, there's been a lot of announcements, particularly in Q2 and Q3 of last year, where we're seeing potentially an upside of 15 to 20% in incremental crush relative to where we are now. That certainly does a lot for advancing the supply of oil that we can have here domestically. Further down the line, that refining capacity is also needed as pre-treatment for the renewable fuel space, and that's where I think we're in the early stages of seeing that. Certainly, some of the announcements that have come out about new plants are kind of bolting on pre-treatment facilities, which will help enable that. So I think the debottlenecking will be happening there as well, and just kind of unfolding as some of these plants come online in the next 2 to 3 years. Now, in terms of just the overall, feedstocks and everything, if we see anything close to what the announced new capacity would be on the renewable diesel side, yeah, there will be a really substantial draw on feedstocks. And if you balance it out, obviously it's not all going to come from soybean oil. Even if soybean oil is at 50% of the feedstock share of what's coming online, we're still going to need, I think, more oils to meet that. But that's where I think we have to look, as kind of a collective, and look at a number of different solutions here. First off, canola at present does not have a regulatory pathway to be a feedstock for renewable diesel. It'll likely get a pathway within the next year or two. So I think that'll provide some degree of alleviation, whether it's some increased canola acreage in the northern plains. Again, that's building off of a very small base. We currently grow under 3 million acres across the whole country. Potential for imported canola oil from Canada as well. There's certainly a lot of plants being built out there, and that'll help alleviate things too. The other thing that I think is worth considering also is our neighbors to the south in Mexico have some overhead capacity in terms of crush. So while we're going through this intervening period as we're building out crush plants, Mexico is also, of course, phenomenal purchaser of whole soybeans, our second largest export destination on a country basis behind China. So I think there's an opportunity to send whole beans down there and potentially bring back some of the oil. To which you might be asking, well, if we're importing oil, isn't it subject to tariffs? Yeah, bean oil imports are subject to tariffs, but not from the countries in which we actually import it, which are Canada and Mexico primarily. They account for about 98, 99% of the soybean oil which we do import. So that, I think there's a couple creative solutions that the industry can collectively come together, but really it all starts at the farm. And I think, being at this backdrop of really strong demand, I think demand on the oil side, but also seeing this resurgence in meal prices is going to be good. And I think, provides that additional incentive for, acreage as well as investment to continue to ensure that we grow that strong crop to meet that demand. So I'll pause my comments there.
I think Mac really hit the nail on the head with that. I don't see the bottleneck right now being soybean acres. I see the bottleneck being the crush and the refining capacity. So a 15% increase in crush capacity would take about 7 million more acres of beans. That's what it would be able to utilize. If you look at what we export, we could easily swap that out. So we have plenty of beans. It's, do we have the facilities to produce the soybean oil that we need? And we have seen shifting patterns in soybean oil trade. We have been a net importer for 2 months this past year. Only 2 months. We had it was very brief, and one of those months was just barely. But I do think long run we could see a sustained shift in some of that, just because soybeans, as we all know, are really two products: soybean oil, soybean meal. And so how much soybean meal do we need here? And so I think we will see some shifts in some of those patterns, and we'll continue to see increase in crush capacity, but it takes years to build that as well. So it's not going to be an immediate need for millions and millions more acres immediately. It's gonna take some time to get there. And so I kind of see this as a short run and a long run question. Short run, plenty of acres. Long run, maybe we could use some more there. But I think there's some time, and I think the markets will kind of work themselves out and price accordingly to allocate the resources where they need them, be that crush, refining, or acres.
Thank you both for that. We'll move right into our next question here, and this kind of piggybacks off of what we were just talking about, but I'll go ahead and share it here so we can see. So they want to know, could Scott share a list of these new soybean crush plants or where that capacity is proposed?
Yes, absolutely. I'm happy to do that. Brock, if I send those to you after the webinar, would you be able to send those to the participants?
Yeah, absolutely.
Okay.
Okay, and then we'll move right on here. Here's another question relative to the topic here. So once we get these additional crush facilities built, what do you see the additional soybean meal as? Would it be, export meal, domestic use?
Mac, I'd love to hear your answer to this first.
Sure. It cut out for a second, but I get the tenor of the question is, okay, well, what do we do with the increased meal as we're crushing more and more for oil? And I really think it's a three-pronged approach. So first, let's start at home, where we have a phenomenal disappearance channel, literally right in your backyard, in the hog space. Now, over the last 20, 30 years, we've seen some loss of share in rations to synthetic amino acids. And I think right now, even with the recent rally in soy meal prices, I think there's a good opportunity for us to potentially regain share in domestic rations, on the basis of some cost differential, relative to synthetics. Of course, synthetics, a lot of which are sourced, from overseas, and, with a lot of the supply chain issues are, of course, escalating prices there. So I think there's a cost competitiveness component that can help out, but that's not going to be everything. I think it's also a redoubling of some of the marketing efforts, and this is where I can get a little bit over my skis, but so I'll just kind of parrot things that people who actually know something about animal nutrition have told me, and that's we've traditionally really thought about the crude protein is that key variable or key component of soybean meal and really what drives it. But, looking at other things like carbohydrate fraction and, some of the other micronutrients, just basically the whole nutritional profile of soy meal. And I think, doing a little bit of re-education and knowledge transfer on that, particularly domestically with producers, I think there's an opportunity for share gain there. And then, but that's not to say that, all of the incremental soy meal production is going to be absorbed domestically. We, of course, have to look to international channels for that as well. And that's where, I'm particularly excited about the prospects in Latin America. So just to refresh, much of our Latin American buyers are set up for receiving meal. There's a couple countries, Mexico and Colombia certainly come to mind, where there is, a mature crush infrastructure, which allows for the importation of whole soybeans, as well as the co-products. But, through much of Latin America, you don't have those crush plants, and they are set up to receive soy meal. Moreover, we presently enjoy, very strong market share across the region. And I think what that's done is enabled a clear preference for U.S. origin soy meal in many of those countries. So I think there's opportunity to leverage that existing strong position in the marketplace, but also let's look at some of those countries as well. Ecuador is a success story I like to point out a lot because it's grown from being, a market that didn't really import much, even 10 years ago, to one that, is consuming over, 600,000 tons from the U.S. annually. And, a lot of what's driving that is growth in the aquaculture sector, which is, really poised to expand significantly over the next 10 to 15 years. As I've looked at some of the forward-looking projections on where incremental meal demand is going to come from, we're expected to see, 60% plus growth in total soy meal demand from aquaculture globally. And with a lot of that, kind of centered in Latin America, I think that's an exciting opportunity as you have that industry natively grow. There'll be more draw for soy meal. There's of course a lot going on in the animal science space that can potentially allow for higher inclusion rates. These are all, I think, levers that can be pulled. And then, I think as we look at other parts of the globe that are, a little bit earlier on in the protein and dietary improvement curve, particularly Southeast Asia and to an extent the Indian subcontinent as well. In India, if we want to stay on aquaculture, I mean, they're, I think the world's largest shrimp producer, and most of that is primarily for export. So it doesn't, we traditionally think about protein expansion in terms of what's being consumed in an importing country, but, it would be the soy meal that's consumed in India for shrimp and then re-exported to other markets. So you can look at growth, not just in the country that's importing from us, but, kind of that halo effect of where it goes back out to. And in Southeast Asia, we don't presently enjoy, I think very, very strong market share throughout much of the region. But our teams continually work there, and we do send, I think, decent enough large volumes, and certainly the Philippines is our number one export market for soy meal. And I think it's worth pointing out as well that, we talk about China being really severely adversely impacted by African swine fever since 2018, but the Philippines has too, and they're, I think, further back in along the trajectory of remedying ASF in the country. So last year we saw a dip in our soy meal exports to the Philippines. We're seeing at least marketing year to date some rebound in that market. So I think as they get ASF more under control, that'll be beneficial for soy meal. And again, that's something where we can leverage an already strong position there. So I think there's a couple different channels through which we can look for that additional meal offtake, and having that mixed approach between, how do we approach it domestically versus how do we strategically target our overseas markets is a pretty sound approach.
That's a great answer, and there's not much to add to that really. Just a couple of really small points. One is if we build out all this crush, it's I believe like 7% increase, or 7% of the crop. So we're not talking about all of a sudden, have just sitting on all the soybean meal. It's more, absolutely, but it's not that we go from exporting beans to only exporting meal. It's a share of that. The other is there's already work going on and groups looking at how do we handle the meal. I especially think of like North Dakota, that's traditionally grown beans to export to the Chinese market through the Pacific Northwest. Now they're getting 2 crushing plants and they're looking to export meal. That takes a little bit different infrastructure. I mean, a unit train's a unit train, but some of the port facilities, loading, unloading, it takes longer. And so some of that work is already being looked at, what it's going to take and to try to accommodate that. So again, just a couple of really small pieces of information to add to Mac's great answer there.
The logistics one is a really important one for consideration, and I think truing up that incremental amount is an important piece too, because we need to move it, but it's not an untenable volume.
Okay, and we'll move right into our next question here as we're getting a lot more in. This one will be about renewables. So Grant, I'd love to loop you in here on this question as well. So this attendee is wondering what the value proposition renewable diesel has for soybean farmers. Is this a kind of competition with biodiesel, something that can coexist? How do you guys see this playing out?
Sure, I can start with a general answer, and then I'll let the experts dive in with some of the detailed numbers. I mean, from a soybean farmer perspective, soybean industry perspective, there's no doubt renewable diesel, the industry of renewable diesel as it grows, is going to be good for soybean oil demand. A lot of these facilities that are being planned do not have pretreatment capabilities, and so they are going to be needing to use higher quality vegetable oils, as we talked about, refined, bleached, deodorized oils from soybean processing industry. So yeah, you're going to see a lot of demand pull from the soybean side, or for the soybean side, on renewable diesel. There's about 1 billion gallons, I believe, of renewable diesel production capacity out there, but there's announced capacity of 5 to 6 billion gallons additional renewable diesel that could come online down the road. Now, nobody believes that will all happen. There's a lot of announced projects, and as with anything, sometimes those don't always come to pass. So, but let's say at least half of that does come to pass. That's still going to be a real big increase in overall demand for vegetable oils. But some of these facilities down the road will realize that they may need some additional flexibility, and so they might look to put in pre-treat facility process, and that would allow them to then use other fats and oils like animal fats, and use cooking oils and things of that nature. And Mac, I think, and Scott touched on, canola oil currently does not have a pathway for renewable diesel, but it probably will in the future. But it can be used for biodiesel. So you're going to be seeing a big demand pull there. Will it impact on the biodiesel side? That's a good question. It probably will have some impact because you have additional competition for feedstock. But as with any industry, the most efficient players will be able to weather that. And there are a lot of efficient biodiesel producers who've weathered some up and down cycles in the economy already over the last decade. And I think those biodiesel players, for the most part, that are in business today are in pretty strong hands. And so that's also a positive thing. One other thing you need to keep in mind is that most of renewable diesel production happens in the Gulf area or in the West Coast, or where you have existing oil refineries already, where they have large supplies of hydrogen. That's a necessary component to make renewable diesel. That's not what you find for biodiesel facilities. A lot of the biodiesel facilities are located in the Midwest. And so I think for the time being, we're going to continue to see a lot of biodiesel production in the Midwest. You'll see a lot of renewable diesel production in the Gulf and in the West Coast. Both industries are going to be positive for the soybean farmer and the soybean processing sector. So, and how that all plays out, I think we'll have to wait and see, but certainly there's going to be some impacts. I'll let the other experts kind of dive into some more details.
That's a great answer. Pretty much covered the points I would make. I will say, typically the soybean oil is not the preferred feedstock for renewable diesel, just because things like used cooking oil or animal tallow was oftentimes seen as a waste product, is very cheap, and because it was scored as a waste product, it didn't get the carbon intensity attributed to it. It would go to the raw soybean oil as opposed to the used cooking oil that came out of the fryer, and so they could get higher credits for it out of California. But with all that being said, there's only so much supply of that, and so it's really expected that soybean oil is going to be the feedstock that will be used for a lot of this, and so that will continue to create pressure between biodiesel and renewable diesel. As Grant said, there's some very efficient production. From what I understand, biodiesel plants that have a dedicated feedstock supply are probably going to be okay. And I've also, from what I understand, biodiesel has better lubricity than renewable diesel as well. And so there's some reasons you would want to blend biodiesel even with renewable diesel. But renewable diesel, you can run 100%. It is a hydrocarbon, the same as diesel, meets the same ASTM standard, but there's still reasons you would want to blend biodiesel into that. So I think there will be pressure on biodiesel. I don't think biodiesel is going away. I think we're going to see some shifting around. And I think Grant mentioned a very, very important point. As far as where these plants are located, I think growth in soybean oil demand is good for farmers, but one thing to keep in mind is where biodiesel is generally produced close to the soybean, these renewable diesel plants aren't. So that creates a different rural dynamic as well. It will help soybean prices, but the rural dynamic as far as where production is occurring will be different.
I don't have much to add. I think those are both, very comprehensive answers. Other than to say, I think, the coexistence of biodiesel and renewable diesel, as Scott and Grant both said, is well put. And, Grant and I were actually at the National Biodiesel Board annual conference earlier this year, of course, now rebranded Clean Fuels Alliance of America. And, you talk with the leadership there, and they're very much of the position that, this is, even as we see renewable diesel truly making a splash, there's opportunity for coexistence and kind of, both types of fuel production to exist in the marketplace. The one thing that I want to add in terms of impact back to the farm is as this is evolving and incentivizing real private sector investment in crush facilities, which candidly is what has made this surge seem that much more real, at least to me, when you see that private sector money flowing in. It's allowing for the construction of crush facilities in parts of the country where they haven't had those offtake channels. So in North Dakota, for example, is getting a crush plant. And if you just look at a simple basis map across the country, and you see a lot of the parts of the country where there are negative basis, and the Dakotas, if you're doing red as negative basis, is about as crimson as you can get. Having that offtake channel, I think is going to be beneficial, in that it'll cut, ostensibly cut back on basis there. And then, that's North Dakota, but of course Iowa's getting a plant too with Shell Rock. And I think the way that is structured, where, there's agreed offtake with, I believe it's Marathon is the petroleum company that entered into that joint venture, assuring that they're, taking off the soybean oil. There's some downstream de-risking on the buying side. So I think that's another local opportunity that's unfolding as well. And, it's not like Iowa needs to find new places to disappear that meal. You've got, number one hog producing state. So, I think between the meal and oil and that Shell Rock deal, you've got a lot of bases covered.
One last quick point I'd make on this too, I think on that question was, how will they coexist? I mean, certainly we touched on it briefly here, but I just want to emphasize that there are markets for both of those products, renewable diesel and biodiesel, and Scott touched on the lubricity aspects of biodiesel that you don't get from renewable diesel. So in low carbon fuel standard markets in the West Coast, a lot of times what we're seeing, because of the carbon intensity benefits of both of those products together, they were seeing blends of 80% renewable diesel with 20% biodiesel, an 80-20 blend. Those are becoming very popular on the West Coast. I had some meetings just earlier this week with some home heating oil, bioheat industry representatives from the northeastern states in the United States, who are looking to increase their usage of biodiesel. And you're going to see biodiesel go into blending of heating oil to heat homes in the northeastern part of the country, where heating oil is the main source of heating out there. And renewable diesel isn't something that you'll probably see utilized in that market as much. Renewable diesel, typically, if you don't have some of the carbon credit programs that are out there, can be a little bit more expensive than biodiesel, actually. So there's certain markets where renewable diesel might be a little bit better fit, and certain markets where biodiesel might be a little bit better fit, but there's certainly markets where they're a good fit together. So I think that's something that's positive from both standpoints. And as a soybean farmer, can't really lose too much, as long as we can make sure that there's a growing pie for all these markets to continue to grow.
Great question. Thank you guys all for those excellent insights there. We'll move on here to our next question as we're getting closer to the end of our webinar here. So Ron submitted a question. He wants to know, are there significant transportation issues now that have been holding back exports? In other words, are supply chain issues postponing soybean exports? Exports seem a little slow now, but will there be a surge later because of improving port situations?
I think what we've seen, so if we look at our export pace in totality since September 1st, I mean, really, it's kind of unfortunate that the timing and location of where we had a lot of that port disruption, and that was, and I'm talking whole soybeans here. September, we really got off to a slow start with Hurricane Ida, and I think that, well, we got off to a slow start for two reasons. One was Hurricane Ida with port disruptions in the Gulf, and then two, we entered the season in a pretty tight inventory position, so we didn't have those captive stocks that were just ready to go on September 1st, as harvest was getting underway. So I don't think it's too surprising that we're off of last year's pace. And again, let's recall that last year's pace was far and away a record. Right now, where we are with our pace, it's mirroring a lot more of the 17-18 marketing year, which still stands as our third largest whole bean export year on a volume basis, behind last year and behind 16-17. So I unfortunately, I don't think that there's outbound debottlenecking that is going to come online or is even really the issue right now when it comes to whole bean exports. Really, we're entering that kind of seasonal or that time of the year where our export window is really kind of at the tail end, and the world is turning to Brazil as their crop starts getting harvested. So I think the question here is, over the next couple months, when the Brazilian crop really takes over the global export environment, and the world is looking to Brazil, does potential downside in that crop limit exportability? Now, if we go back to the WASDE, we didn't see a reduction in Brazil's projected exports. It was maintained at 94 million tons, which would be, a record for the marketing year. The question for me is, and this is one of the things we talk about among USEC leadership, is do we, potentially see, we have a pretty, market seasonal pattern in the way that we export, but for this year, do we potentially see an opportunity for more exports towards the tail end of the year, as Brazil gets their exports underway, and we have a little bit more of that supply to sell later in the year? Now, remember, last year we did get off to that excellent export pace, but we were also selling at a markedly lower price environment. And there was a lot of early selling, so that later in the year, once we saw prices appreciate and improve significantly, we didn't necessarily have the exportable volume to send out. This year is a little bit different. We'll probably have that exportable volume. It's at a higher price point. So I think even as we're seeing those volume figures down, that's a potential tailwind to look forward to. Moreover, on a value basis, with the increased unit values on a per bushel per ton basis for whole soybeans, Both October and November, I think, first October set a new value record, and then November beat that again. So even if the volumes are down a little bit from last year, with the higher prices, I mean, that's incremental value back to the whole soybean complex here in the U.S.
I'd say most of the issues that we had were related to Hurricane Ida. We didn't see the slowdown in exports out of the Pacific Northwest during that time. But yeah, as I'm sure everyone's aware, several facilities went down in the Gulf, but also we lost a lot of barges, or there was a lot of barge damage too. And so if you watched barge traffic and barge prices on the Mississippi River for a while after that, volumes were down, prices were sky high. And so, most of those issues seem to be cleared up at this point. And things seem to be flowing as they should. So I think once we kind of got through Ida, there really hasn't been too much of a bottleneck due to infrastructure domestically.
All right, we'll try and fit in a few more questions here from our attendees. It looks like kind of shifting gears here, farmers are continuing to see those impacts from those rising input prices. And I know it was mentioned that, they've started to, dwindle down somewhat. But this participant wants to know, will farmers continue to see the impacts of the supply chain this year in terms of inputs? What can they expect as it relates to those input prices and availability?
So I hate to be the bearer of bad news, but I think fertilizer prices are going to stay elevated for a while. As we mentioned, they have been coming down some, which is very fortunate. But the situation there is very complex. There's a lot of things going on that are pushing up prices. One, high natural gas prices, which we've seen some relief there. Two, we've seen China restrict exports, outright ban exports of fertilizer, trying to keep some of that supply at home. They've been producing less, trying to clean up the air for the Olympics. Three, there's a very complicated trade situation. There's countervailing duties on Moroccan and Russian phosphate imports in this country. Those are on for those were put on for 5 years starting last year. It's currently in appeal at the International Trade Commission. The American Soybean Association has joined several other ag groups, filing an amicus brief trying to overturn that countervailing duty. We're awaiting word on that, but if that doesn't happen, we have 4 more years of this. And also we're seeing UAN potentially getting the same sort of countervailing duty. We've also on the K side, we've seen Belarus, one of the world's largest exporters, have sanctions go into effect because of their regime there and some of the actions they've taken. So that's hurt world potassium exports. So there's a lot of things going on. It's not going to get fixed immediately. Any one of these things would be pushing up prices by themselves. But then you get to some of the chemical inputs, and that gets to be large world supply chain issues as well. I mean, lack of containers, trucking, COVID, people not being able to go to work in places like China or the US. And it's hard to know exactly how long some of this will take to unwind, but I don't see it being a month or 2. So I think some of these issues are here to stay for a little while, unfortunately. I wish I had a more optimistic view, but I think, to be real, that's the reality we're going to face for just a bit here.
Yeah, I wish I could offer a counterpoint there, but I really can't. I think Scott encapsulated things quite nicely. The only thing I'll add that is if you look at I was actually on a call with International Grains Council earlier this morning, where there was economists from the Food and Agricultural Organization of the UN on and discussing this very topic of fertilizer prices. And the way that it was framed is really, I think from a geopolitical standpoint, if you look at, just the relative concentration of the export of, whether you're looking at NP or K, For nitrogenous fertilizer, it's Russia and China are the two largest exporters that collectively control probably 35% of total exports there, and both have issued, as Scott said, export restrictions, if not outright bans. China, of course, trying to clean up its air, and China had reduced capacity as well, I think, to curb on some of the natural gas costs when natural gas is really even higher a couple months ago than it is now. And as Scott, of course, mentioned the sanctions in Belarus, which is on the potassium side too, and then of course phosphorus. You have the issues with Morocco. So I don't see it unwinding anytime soon. I think we kind of have to think about higher input costs at least for a couple seasons. On the chemistry side, maybe that improves quicker. I think that we had a really acute disruption earlier this year where some of the production facilities, at least for glyphosate in Louisiana, were disrupted by Ida. So there was kind of a rerouting of capacity. And I know that the companies involved there, were trying to do what they could to, de-bottleneck and help supply the North American market. But there are, still capacity issues unfolding. Now, of course, China also implemented an export ban on phosphate rock, which is a critical input towards producing glyphosate. So that's an issue as well. But unfortunately, I think these elevated input costs are going to be here, for a little bit.
And one other thing I will say is the ag groups, including ASA, have been approached by the White House who want to hear about supply chain issues that farmers are having. So if you're having issues, please let Iowa Soy know, and they can pass those on to us, and we could send those issues directly to the White House.
All right, thank you both very much for those points. We will try and stay on time here today, so we will just kind of end the Q&A portion. If we weren't able to get to your question, we'll be sure to capture those and send them over to Scott or Mac or Grant just to get an answer and pass those along to you. So with that being said, I will pass it over to Rob just for some closing remarks and thoughts.
Hey, great. Thank you, Brock. Hey, I appreciate the insight, Mac, Scott, Grant. Great information. I'm glad that our members took advantage of your wealth of knowledge here, and hopefully it helps them out and makes them a little bit more profitable and for the year to come. And just want to thank everybody for joining Iowa Soybean Association's webinar today, and to remind everybody that we have an upcoming event on February 17th, which will be the Innovation to Profit Conference. So it's going to be at the FFA Enrichment Center in Ankeny, and it'll help you to unlock your profit potential. So we'll and to register, it's pretty easy. All you have to do is go to iowasoybeans.com, and they got a great website that'll lead you right through it. And I'm a firm believer that you can never have enough information when it comes to marketing and this day and age. So I guess with that being said, we're at 8:29 is what my clock says. So appreciate you all taking the time, and thanks again. We'll see you all.